All right, so the day after Christmas, right, while most of us are still recovering from the holiday festivities, something strange happened. Something deep inside the financial system's plumbing. Today, we're going to unpack exactly what that was and the absolutely explosive theory about what might have caused it.
So in this super quiet, early morning hours of December 26th, a number just pops up on the Federal Reserve's official data feed. And get this, it showed that some of the world's biggest banks, they'd quietly taken an emergency overnight loan from the Fed. The amount? A staggering $17 billion.
Now, let's be clear, this was not a planned loan. It wasn't for something normal like payroll, and it was definitely not routine. So what was going on? Why on earth did major financial institutions need a massive emergency cash injection on what's supposed to be one of the quietest trading days of the entire year? Well, that's the big question, isn't it? Let's dig in.
Okay, so to really get to the bottom of this, we have to follow the money. We need to look at exactly where it came from. Now, you might be tempted to just brush this off as some weird, end-of-year accounting thing. But the specific place this money was drawn from, well, that tells a very different story. It hints at just how severe the situation really was. So this $17 billion? It came from something called the Fed's Overnight Repo Facility. And you really need to understand what this is. Think of it like the financial system's pawn shop of last resort. Seriously, healthy banks? They avoid this place like the plague. They borrow from each other. Going to the repo facility is basically the banking world's walk of shame. It's a huge flashing red light that says you're under serious financial stress and nobody else trusts you enough to lend you cash. Okay, so let's recap. We have big banks, clearly under stress, taking a massive emergency loan from the place you only go when you're desperate. And this brings us to a really explosive theory. The idea that this wasn't just some random banking hiccup. Nope. The theory is that this was a secret bailout and it was all connected to a crisis that was boiling over in the silver market. And this quote from the Currency Archive it nails the accusation perfectly. This $17 billion is not a stimulus check. It is a tourniquet. I mean, think about what that means. The argument is that this wasn't the Fed trying to help the economy grow. This was a panicked, reactive move. It was a desperate attempt to stop a catastrophic financial bleed, before the patient died right there on the table. So what's the theory? Well, here it is in a nutshell. The claim is that major banks had made these massive, massive bets that the price of silver was going to fall. But then the exact opposite happened. The price shot up. And that sudden move meant they instantly owed billions of dollars to cover their losses. Billions. And the problem was, they just didn't have the cash. You might be asking, wait, how is that even possible? Well, it all comes down to one word: leverage. See, a bank can control a huge amount of silver with just a tiny bit of cash down. But here's the catch. If the price moves against them, even a little, that small deposit gets totally wiped out. And the exchange comes knocking, demanding they cover the entire massive loss in cash right now. And that right there is how a seemingly small price move can trigger a multi-billion-dollar crisis, like literally overnight. All right, so that's the theory. Pretty wild, right? But now let's look at the evidence. What was happening in the silver market? Why was it under so much pressure that it could supposedly bring major banks to their knees? First off, the timing is absolutely critical here. This all went down during what traders call Ghost Week, that period between Christmas and New Year's. Think about it. Most traders are on vacation. The market is dangerously thin. That means there are way fewer buyers and sellers, so a single large order can cause a huge, violent price swing that just wouldn't happen on a normal trading. And underneath all this drama is a much bigger, more fundamental problem. I mean, just look at this chart. For 7 years straight, the world has used up way more silver than all the mines on Earth have been able to produce. This isn't some one-time blip, folks. This is a chronic, structural deficit. We've been draining the world's stockpiles of silver year after year after year. And if you want to put a number on it, just between 2021 and 2024, that shortfall, the gap between what we used and what we mined, was almost 680 million ounces. That is an immense amount of metal. It all had to be pulled from existing vaults, from stockpiles, just to keep the lights on and meet demand. So where is all this demand even coming from? Well, this chart is pretty revealing. Look at this. More than half of it is for industrial use, where silver is just irreplaceable. And then, check out that second biggest slice right there, solar panels. And that piece of the pie isn't just big, it's also the fastest growing part. Why? because you literally cannot build modern, high-efficiency solar panels without silver. Okay, and this brings us right to the heart of the matter. This is the core conflict, the real tug-of-war that might have lit the fuse on this whole crisis. And that's the growing disconnect, the split between the price of a paper promise for silver and the price of the actual real physical metal. And you can see that price gap right here. In late December 2024, you've got the New York COMEX, which is mostly a market for paper contracts, pricing silver around $79 an ounce. But then you look over at Shanghai, where industrial users go to get the actual metal, and the price was $85. Now, that $6 difference, that's not just shipping costs, that's the price of reality. That's the premium that real buyers were willing to pay to get their hands on real silver, not just a paper IOU. And you know what? The paper market was starting to crack under the strain. In December, a record 63.5 million ounces were demanded for physical delivery from the COMEX. Now, for an exchange that's mostly designed to settle in cash, this is basically a run on the bank. It's a huge sign that buyers were losing faith in the paper promises. They wanted the real thing, the actual metal, and they wanted it now. All right, let's just zoom out for a second and get some historical perspective. For thousands of years, going back to the Roman Empire, it took about 12 to 15 ounces of silver to buy 1 ounce of gold. It was a pretty stable ratio. But today, as of late 2024, it takes around 50 ounces of silver to buy 1 ounce of gold. Now, the folks who believe in this squeeze theory, they point to this and say, look, this is a massive historical distortion. They argue it's a sign that silver's price has been artificially held down, creating this huge anomaly that markets, sooner or later, tend to correct, and often they correct it violently. So let's put all the pieces of the puzzle together, shall we? When you combine this fundamental shortage of physical silver with the weird mechanics of the paper market, yeah, you can start to see how a crisis might have been brewing just beneath the surface. I mean, what this theory really describes is a perfect storm. You've got a chronic supply deficit that's been going on for years. You've got record-breaking industrial demand, especially from solar. All of this is happening during that dangerously thin ghost week for trading. And at the exact same time, the price for real physical metal in Shanghai is breaking away from the paper price in New York. And who's stuck right in the middle of this mess? Major banks, who are apparently leveraged to the hilt, betting that the price would get old town. And all of that leaves us with one last big, provocative question. You know, whether this specific theory about the $17 billion is the whole story or not, the underlying conflict is very real. You have a battle between a theoretically infinite supply of paper promises and a very finite supply of a critical real-world metal. And when those two things collide, something eventually has to give. The only question is, what breaks first?